and record. So again, guys, for those of you guys who do not have access to this data vault in here, please let me know so I can share it with everybody. This is going to give you guys everything that we have in here. Our closing costs, our closing material, our class material, the appraisals and inspections, home buying 101, and everything like that. Okay. Now in here in the class material, you guys will also have access to everything we have done before. So all the information in the beginning in terms of the intro items, all of the basics that we have touched base on, and then the agendas that we have in place today for closing. Okay. So we have all those informations. Now, going back to the Monopoly board, the one thing I want to touch base on with everybody is understanding when we're talking about the home buying process, again, what are the steps? One of the most common things that I always learn is a lot of consumers are naive to the process, right? You truly don't know where to get started, right? And when we're going through the pre-approval process, you know, our team likes to keep it as simple as possible, as I'm sure many other professionals do as well. We generally just ask for 2 most recent W-2s, tax returns, not as much sometimes bank statements, just an understanding of where your income is coming from, and then your driver's license. Once we've established that pre-approval, then we look to search for a home, which, as most of us are aware, inventory levels right now are a little on the lighter side. So we are kind of dealing with a little bit of appraisal shortages and things on that nature. We're dealing with some inventory shortages as well. We'll kind of keep that up to date later on. Actually, the following session, I'm going to be talking about what are the necessary fall strategies that we need to be implementing as we slowly start gearing into the fall season and what that impacts in terms of inventory and stuff. Then we go through the formal application process, contracts of agreements of sales and things on that nature. Okay, so these are some of the top topics that I want us to go over. Appraisal is going to be on a different day that we're going to go over all those various informations on there as well and kind of touch base from there. Does anybody have any questions? We are good. Okay, cool. So now going back to, again, the class material in place, what did we touch base on the prior seminar? So as I mentioned, we went over the home buying seminars in regards to the 4 C's. I ran through this very quickly. I'm going to repeat it again. So when we're talking about the mortgage process, again, we talk about the 4 C's. We take a look at a consumer's capacity to repay the loan, their debt to income, essentially. How much money does the consumer make versus what is the revolving debt that you currently have against you? That is going to specifically affect your debt to income. Then we take a look at your capital. Where is your money essentially coming from? Okay. And is your money seasonable, right? We need to know where is your income? How is your income coming in place? Do you necessarily have the adequate funds, most importantly, in order to qualify? Okay. You know, a lot of consumers, which is going to be the topic of discussion right now, is we're going to talk about closing costs. Okay. And do me a favor, there is no such thing as percentage to closing costs. Please get that myth or misconception out of your, thinking, because it's very difficult for an average consumer to be looking at a $200,000 home and all you see online is it's anywhere from 2 to 6%, which is a massive spread, right? It's like when you're trying to get your cable fixed and they give you a huge window, it's impossible to put a specific percentage. I can confidently tell you guys that based on experience in the state of New Jersey with how taxes are and things on that nature, if you're looking around like Northern Jersey where your taxes are anywhere from like $10,000 to $12,000, your average total closing cost is going to be $15,000, which is, we're going to dive into everything in detail, plus your down payment. Okay, so when we're talking about capital, we want to make sure that we have the necessary funds, first of all, available to us. And then if we are talking simultaneously about closing costs, we also need to make sure that we're also going to cover very briefly, actually, a circumstance I was running into today, educating our clients about sometimes a client must have reserves where you need to show additional money that you have in place on top of the income that's required. Okay, again, all topics that we're going to cover today. Then when we talk about collateral, if you guys recall, that is essentially the home that you're buying. Is it worth it? And what's the standard procedure of it coming into play? And then we take a look at your credit, right? Your credit score, obviously, we all know. Later on throughout the home buying seminars, we'll be talking about credit scores, bringing on a few different financial consultants that I have in place and some of their true recommendations of what the credit process takes care of, right? We went over your standard FHA loan and conventional loan. I'm not going to dive in too much into that because it's a whole nother topic, but understanding the various differences between the two. And then probably one of my favorite slides that we had a lot of engagements with was in regards to common questions, right? So how do you qualify for a loan? We just went over that. How do you save for your down payment? We just touched base on that, where your money needs to be built in. Remember guys, when you're buying a home, bought my house fairly recently, about 2 years ago, we're already having the mortgage insurance removed and really didn't do much to the home, right? So understanding the equity that you're building in it and you having the ability simultaneously, what fits your individual needs. Almost every single client that I talk to in today's market, I tell them, save your extra cash, keep it on the side, because I would rather you, Mr. or Mrs. Client, have an extra $100 a month per month as a monthly payment and save anywhere from $3,000 to $6,000, depending on the loan amount and depending on the circumstances, knowing that the market is going to turn. Right now, I'm going to be brutally honest with you guys. The market is in this like seesaw, as it has been over the last 3-4 months. The market has truly been in that seesaw. But again, it's been like this for quite some time, where we've been teetering within those windows. One of the things that I want us to understand is, if we have those 4 C's that I mentioned to you guys, our credit's right, we have our income, we have our capital, we know the home that we're looking for, we have our trusted real estate partners that are guiding us in the right direction, and we have the ability and the capacity to afford the loan, there's no right or wrong time to buy a house, right? It's on the opportunities of, does it fit within your budget, one, and what makes better sense for you. My job is to make sure that I guide you and provide you with the necessary options. It is up to you as the consumer to tell me, no, Abdel, I would rather pay a little bit more upfront and get a slightly lower interest rate or a slightly lower monthly payment. Or Abdel, I agree, I would rather bring a little less money to the closing table currently upfront, because I know this is not a loan that I'm going to be keeping forever. Okay. We went over that. We went over very briefly FHA condos and what are the emphasis of that. Very minimal importance that, or I should say, very minimal number of condos have FHA approval. So that is something that we really take a look at to make sure that it's eligible. And if it's not, the link is in here. Asset sourcing, I touched base with you guys. Super, super important that when you're looking to purchase a home, there is no money under the mattress, right? So we are obligated under anti-money laundering laws and the Bank Secrecy Act. We must make sure that we know where the money is coming from. Yesterday, I was coincidentally at my sister's house, and I haven't been there in months, which shame on me. But she had just gone to a car dealership and she had purchased her auto loan, and she essentially paid cash for it. So when I was there, she showed me a paper from the car dealership where they had filed the IRS 8300 form. I already knew that was going to happen because they paid cash for it. They're obligated. We follow the same parameters. So anybody here who's ever worked in financial world, banking, car dealerships, or anything of that nature, where usually cash is exchanged. So we fall under very similar parameters, right? We need to know, where is the money coming from? How did it get there? If we start seeing some consistent deposits, generally banking, they're supposed to file a SAR, suspicious activity report, something doesn't seem right, right? So I'm not trying to be a pain, as I tell clients, when you have money from a 401k. Well, dude, we need to know how much money is in your 401k. How did you get there? Has it been sourced? Did you just start the job? Do you have access to liquidate it, or are you capped? Again, not as a means to be tedious, but following industry guidelines set in place by Fannie Mae and Freddie Mac. Okay. Mortgage discount points we'll kind of cover actually in detail today. That's probably one of the hottest topics, so to say, right now in this market, right? In regards to, does it make sense in order to purchase a home if you take that route? We're also going to go over what's included in your monthly payment, right? I get this question asked probably every single day, where when I'm talking to a client and I'm telling him, hey, dude, your total monthly payment is $2,800. And the client's like, oh, I got to pay $2,800 and I got to pay my tax. And no, when I tell you your total monthly payment, that is everything. and it's broken down. I'm going to explain it right now to your PITI, your principal, your interest, your taxes, and your insurance. We gather all that information. We get the proper tax recording. We get the proper insurance based on the quote that you get. We will always recommend a colleague of ours. Our last call, I had a colleague of mine who was on here who was giving us some understandings of the insurance market, because that's simultaneously shifting as well. And then we kind of take it from there. Okay. Closing costs is going to be the topic at hand today. And then first payment due, we'll dive over a little bit more. Does anybody have any questions on some of the basic stuff that we covered within the last 2 seminars? We're good. And if you guys are driving or whatever the case may be, feel free to drop your questions in the chat box in Zoom. Same thing with those of us who are tuning in via Facebook Live and Instagram. You guys can simultaneously also drop the same, and I'll do my best to get to everybody. Okay, so now let me pull up the presentation. Okay, so again, guys, the topic that we're going to go over today is the importance of closing costs. So we're going to dive into what are closing costs, are they generic, what makes them higher, what makes them lower, does it matter what location you're buying, does it matter what home type you're buying, and things on that nature. Okay, so there's just an infinite number of variables, infinite number of different opportunities for your closing costs to change. So I really want to make sure that we're all familiar with what they are. Okay, so going in, so again, as I mentioned, a consumer's down payment is not the only thing that is due at the closing table when you're purchasing a home. Okay, it's the closing costs on top of that. And the literal definition of closing costs is closing costs are expenses that you pay to your lender in exchange for loan services. I'm really a big fan of that definition, but not necessarily wrong, right? Closing costs are essentially paid based on various different third-party affiliates as well within the transaction, which we're going to dive in detail. Okay. Now, a lot of first-time homebuyers, guys, that I work with generally have different misconceptions. You know, I was doing a deal right now. We have a satellite branch in Detroit, Michigan, and I have a client who was thinking their closing cost was going to be about $2,000 to $3,000, right? They went on the internet. They're buying a $500,000 home, which is generally the price ranges down there. They looked at 2 to 4%. They were under the impression that their closing cost was only $2,000 to $3,000. Not true, right? So I always tell them it's very difficult to put a specific percentage, but I'll show you guys what my personal ways of what I look at it, looking at different avenues of scenarios, and then we take it from there. Okay. Now, again, understanding closing costs, as I say, it is difficult, but you always will have an understanding of what your closing costs are going to be broken down to. There is no such thing as surprises. Okay. The federal government has alleviated that with so many different rules and regulations, right? We've had RESPA, which is the Real Estate Settlement Procedures Act, that literally came out to make sure that every single consumer is aware of what their potential costs are. And most importantly, you have the option to choose which title company that you want to use, which attorney, if you even want to use an attorney, right? State of New Jersey, it's voluntary, and things like that. Okay. So again, what are closing costs? So closing costs are fees. Yes, it's collected by the lender. It's costs that include things along the nature of your appraisal, your title, your attorney, and other third-party costs, such as a recording fee, right? Or you may necessarily get a survey fee that you may have to pay, just so you know where your property starts, where your property ends, and things along that nature. Okay. So now simultaneously, specific closing costs, again, that you pay for in addition, when I talk about your prepaids and escrows, guys, that's going to depend based on what? It's going to depend based on the taxes and the insurance of the property. Okay. So just want to make sure I didn't miss any questions, but that's going to depend based on the taxes and the insurance of the property. That is going to give you a firm understanding of what exactly you are looking to expect to pay at the closing table. Okay. Now, again, as I always say, it's very, very difficult to put a specific percentage to closing costs. Okay. There's just too many factors that are involved. Now, again, closing costs if we were to put something close to it, can make up 3 to 6% of your loan amount, right? Again, a big spread, but that's generally the emphasis of what I usually see. This means that if you take out a $200,000 mortgage, you can expect closing costs to be about $6,000 to $12,000. Okay. Again, so tough to put a percentage to it, right? Because 6 to 12 is basically double, right? The rule of thumb, as I always say, a $200,000 mortgage, the property taxes are probably going to be cheaper. So I would say you're probably looking at closer to a cumulative closing cost of about $8,000. Okay. Now, with taxes and insurance, again, being the major determining factor, where generally, guys, the higher the home value, right? Usually the lower the percentage if you were to put a percent to it, right? So if you're talking about a $500,000 home, it's not going to be 6%, right? You're talking $30,000. It would probably be closer to 3%, like I was saying before, which is essentially $15,000. Okay. Now, in addition, guys, now again, determining kind of on how market conditions are, but the seller also does have the opportunity to pay your closing costs. Okay. So there's something called seller's concession, which we're going to dive into again, but closing costs, it depends on the circumstance. Again, I'm as trustworthy and honest as it gets. It is a very competitive market. So the ability for you to get seller's concession in some instances with closing costs is sometimes very difficult. It is not impossible. I can confidently tell you that. I just closed one for a client in South Amboy. We got her a $16,000 seller credit, actually $6,000 up front when we negotiated the contract acceptance, and then $10,000 for a roof credit. The client didn't want to replace the roof, so we got that. So again, various different avenues for you to understand. I just have a situation right now with a client. Assets are very tight, but the house overappraised. And because the house overappraised, we basically asked for a seller's concession of $4,000 because the house appraised for $219 and we're getting the purchase price for $215. So we asked for a $4,000 concession. Although the price increases to $219, the client gets that $4,000 up front to pay towards their closing costs, prepaids, or escrows. Okay. Now, again, just be aware, as I mentioned, when we're looking to go for seller's concession, it does what I call reduce our negotiation power, right? Depending on the type of market that we're in. So, like I said, when we're talking about seller's concession, there are also what's called specific caps that are in place. Okay. So when we talk about seller's concession, the caps that we look at that can be in place, an FHA loan, the max that you can ask for when it comes to seller's concession is 6%. Now, remember, guys, seller's concessions can only be used towards your closing costs, your prepaids, or your escrows. Seller's concessions cannot be used towards your down payment. Your down payment must come 100% from you or a donor, but must come 100% from your sources. It cannot come from the seller contribution, because I get those questions all the time, right? Conventional, if you're putting less than 10% down, the max seller's concession that you can get is 3%. And if you're putting more than 10% down, then you can ask for 6%. Okay. On an investment property for any of our investors, the max that you can get is 2%, actually. So if you're looking to buy an investment property, the max seller's concession that you can ask for is 2%. Okay. VA USDA, not to dive into it too much, but just for your information, in case any of us are veterans, because I do a lot of VA loans, 4% is the max that we can ask for in terms of seller's concession. Okay. Does anybody have any questions about seller's concessions or any comments or anything of that nature? Because I know that's a very, very hot topic, for somebody who's looking to put some of their assets together. Any questions that you guys have in terms of that topic?
We love you, Abdel.
Thank you. But so again, remember the importance of the closing costs. We're going to dive into it super detailed as to what's in there and all the information that we're supposed to know. But again, guys, when we're talking now on the topic of seller's concession, FHA, the max seller's concessions that we can ask for is 6%. Obviously, we can ask for less. VA USDA, 4%. And then conventional, if you're putting less than 10% down, 3%. And if you're putting more than 10% down, 6%. All right, guys. So now moving on, what if I want a lower rate, right? How many times does this topic come into it? And to be frank, where markets in like this little unique situation, many consumers, you really don't have a choice to lock your interest rate and not pay discount points, right? I'm not going to say some consumers don't, but in many instances, when a consumer is looking to lock their interest rate, especially right now where margins are a little wacky, many consumers must lock their interest rates. And even if they go with the highest rate possible, they still have to pay something, whether it's $1,500, $2,000, or anything of that nature. Again, that gets tacked onto your third party closing costs with your prepaids and escrows. But how does it essentially break down to? So again, so the cost of a mortgage point is equivalent again to 1% of the total mortgage amount. Okay. So for example, if you're purchasing a $200,000 home, if you're going to pay 1 basis point, that's $2,000. So the interest rate deduction you'll receive in exchange for a point. Now, this does not necessarily mean that I'm a consumer and I'm looking to pay 1 point. That doesn't mean, I mean, so many different scenarios, right? But let's say your interest rate is 7% and you want to pay a point. That doesn't automatically mean that you're going to go 1 to 6%, right? Like from a 7 to a 6, if you pay 1%, no. A different circumstance. If you're also simultaneously looking to pay points and you have a 7% and you want to get a 6.75%. What I do with my calculations with my clients is I break it down for you generally with two options. I will always show you as a client what is the cost if you as a consumer are going to lock your interest rate and get the lowest monthly payment. So if you're going to get the lowest monthly payment, you're either bringing the most amount of money down, right? Because you're financing less, or you're bringing also, you're getting the lowest interest rate, which is generally going to have a cost to it. Or as I mentioned earlier, in this market, my preference with my clients are, and remember, I always say this, I have no vested interest. So if you get a 3% interest rate or a 10% interest rate, our compensation structures for mortgage loan originators are all the same, right? So that's a misconception some people have too. Now, broker channels might be a little bit different, although it works very similarly. But as a mortgage professional, from a financial perspective and from a vested perspective, I don't care if you get a 2% or a 10% from that standpoint, right? My job is to show you the options, and then it's up to you to kind of pick and choose based on my preference of what you think makes best sense, right? So now, again, rates change daily. And let me tell you guys, they're not only changing daily, they're changing probably within the minutes. So it's very important for us that we're understanding the options that are available. We're also simultaneously working and understanding what's the best times. So I locked about 5 different clients within the last 2 days and yesterday. The market today took another dip and took a very sharp dip. So a lot of clients right now who locked between yesterday and today, the market has already changed. Yesterday was almost as low as 7.10. The market right now is at 7.20. So any consumer who would have locked today instead of yesterday, the same cost for the interest rate, let's say if you had a $500,000 loan amount, would have been a $2,500 difference between locking today and locking yesterday. Okay. So it becomes so important when we're working with the right professionals that we're truly, truly monitoring this stuff. And when I tell you guys we're monitoring this stuff, monitoring it daily. So this is actually the best, and there's so many websites. This is the one that I usually use. So I'll show you guys one client. And for those of us who are on Instagram, you guys, I have the link pinned. You may have to copy and paste it manually, but you guys have the opportunity to jump on here. You'll get access to us sharing our screen, and then the data vault that I have access to for all of our people that are logged in. But I want you guys to see this. So basically from, let's say 7/15/2023, take a look at that sharp incline, right? And this is kind of where I started to Once I started seeing a little bit of a dip, that's when I started calling my clients and I said, dude, we got a lock. So check it out. From the first, we were at 710 and it sharply jumped up to 7.20. And I'm pretty sure tomorrow we're going to be getting the BLS report, the Bureau of Labor Statistics report. And that's probably going to come in, who knows, to be honest. But future history over the last 3-4 months, Bureau of Labor Statistics is coming out with some bananas numbers. I don't know where they're getting their numbers from, but they're coming out with numbers that unfortunately are not favorable to the market. Therefore, I need to make sure that we protect ourselves from any of those instances, right? Okay, so again, guys, does anybody have any questions about discount points or anything of that nature that I can help clarify us on? See questions in the chat. Can you put the link here? Yes, I will be sharing the Advancing Homeownership Data Vault link. I usually do it at the end of the class, but I will share it for you guys right now. No worries. So, Data Vault. Just shared it for us. So you guys have access to that. Okay. Now, moving on. The next thing that we're going to talk about is, again, kind of piggybacking off of the benefits of paying points, right? What are some of the benefits of why a consumer should be looking to pay points, right? And again, in this in this market, we truly have to just gauge, first of all, what type of access do you have towards your funds right now, right? Do you have immediate access to, let's say you have a set budget that you wanted to close on the home and you put $30,000 on the side. And right now your total closing cost is about $22,000 all in. You have about $8K to play with, or $8,000 really budgeted on the side. I personally will always give my clients the options. All right, dude, if you put $8,000 to this, your monthly payment is going to be X, your cash to close is going to be this. Or let's maybe take half of that, or a third of that, or 3/4 of that, and your monthly payment is going to be a little bit lower, right? Because your interest rate is likely going to be lower and your cash to close is going to be this. And I truly give it the options to my clients as to what works best. I do not like to just tell you, dude, take it or leave it type of situation, because then we're truly not reducing the number of options that we have in place for us. Okay. So now another thing, actually, I had shot a video. I think I posted it this morning or yesterday about, in addition, one of the benefits, guys, when we're purchasing a home in the first place is any mortgage points when we're acquiring a property consistently, when we're filing our taxes on mortgage interest, or even when we file our tax after we just bought a property, points are tax deductible as long as you itemize them on your returns, which basically means that you will pay less taxable income because that's a cost that you pay to acquire the property or acquire the rate. Okay. Again, get with a CPA on that stuff, but that is usually one of the main things I always say. One of the pride of home ownership that you're able to do is tax benefits and tax deductible reductions, right? Now, again, some of the drawbacks when we talk about mortgage points, again, obviously higher closing costs. And then the other thing also is that when you want to compare your savings, as I said, for your interest rate, and in many, many instances, guys, I'm telling you, some of my clients, 6.5 sounds better than 7%. Nobody's arguing with that, right? It sounds better, but the cost to acquire a 7% interest rate is hypothetically, let's say $5,000, and the cost for 7% is only $1,500. That's a $3,500 monthly payment difference. Let's say it's only $100 saving. So that means it's going to take you 35 months to recoup the benefit of what you're basically paying up front. So would it make sense for you to go with a 6.5 instead of a 7? My personal recommendation is no, because when is the last time that we've all, I'm imagining, bought a car at one point in our lives, right? How many of us actually remember the specific interest rate of that car that we bought? Probably going to say not many of us. I'm going to be honest with you, I don't even my own interest rates for when I bought my car. But I do know how much I put down as a deposit when I bought my cars, right? I always remember it was either like $2,000 or $1,000, and I didn't want to put more, right? Because I didn't necessarily want to obviously put more cash out of my pocket, and I'll take the slightly higher payment. It's the exact same thing when you're purchasing a home, okay? And just like when you're purchasing a car, the interest during the very beginning few months, guys, is almost sucks, but it's like 90 to 95%. And I don't care if you have a 2% rate or a 9% rate, you are still simultaneously going to be paying a majority of your monthly payment towards the interest. Okay. You know, so many clients that I know, who, let's say they bought a house, and I'm doing a lot of cash out refinances right now. Believe it or not, it's funny. Every time I tell that to people, they're like, how? Explaining the differences when we're looking at your credit cards, we're taking a look at HELOCs, we're taking a look at various different avenues of payments that you have. And then we're looking to carry over some of the balances of what you have, and then you end up saving money, right? But for example, we also take a look at, prepaying mortgage insurance is another alleviated cost that you can acquire when you're purchasing a home as well. Okay. And so again, are mortgage points worth it? Really depends on it. Many instances, as I've mentioned, I do always recommend my clients to pay some points so they can get that sweet spot. But again, yes, if you plan on living in the home for a long time, the longer you plan, depending also on the market, right? The more sense it makes sense. In other words, if you're looking to pay points, it can be well deserved. If you're planning to stay in the home forever, again, keeping in mind the market that you're living in, okay, or the market that you're purchasing in. Now, in other words, no, where if you're looking to simultaneously downgrade, relocate, or you're better off keeping more money in your pocket at closing and paying a higher monthly payment for a shorter time period. That is what I always recommend my clients. I would say literally for the last, since 2022, I would say is what I have been recommending this to my clients. I would say since March, April, when the market truly shifted and we went from the 3s and 4s to the 5s and 6s and now 7s. That has been the recommendations that I have been telling our clients, so we can truly figure out what is your break-even point. And in many instances, your break-even point is likely going to be that much higher than the expectations of you refinancing that. Okay. So this is just a very brief example of what I have generally seen. It's a truly generic breakdown of what fees are included in closing costs, but just so you guys have a very firm understanding. So usually lenders' fees can vary anywhere from, I would say, $1,000 to $2,000, about $1,500. Your appraisal fee, generally you pay it up front. Again, probably gone up more depending on the property too. If you're buying a multifamily home or a condo, but let's say $500. Your credit report fee, which is usually can be paid for up front, is about $100. Your attorney fee, again, in the state of New Jersey, is not mandatory, about $1,000. Your title fee, again, guys, these numbers are pretty light. I'm not going to lie to you, but just to give you guys at least an idea, this is probably for more or less like a $250,000 home, about $1,500. Usually, I would say for a $300,000 or $400,000 home, it's about $3,000 to $4,000. Your recording fee, about $500, is pretty standard. Now, here is where we're going to cover our prepaids and interest. So every single person who purchases a home generally is going to pay 2 months of taxes, 2 months of insurance during your escrow, and then you're going to pay 3 months of prepaid taxes and 12 months of insurance. And that is usually where a lot of the bulk of closing costs are required. Now, the crazy part is that your escrows, that's your money. That's what the bank holds on the side for you. That is basically the piggy bank that banks are required to have. Okay. But make sure, guys, that you have that firm understanding. Probably one of the biggest, I would say, fees that can vary, because most of them are truly, truly regulated, is probably the title fee. And the title fee, mainly the reason why the title fee could potentially change is just the title insurance. Okay. Because if they're insuring a little bit of a more expensive home, title insurance is going to be a little bit more. If they're insuring a home that's a little bit cheaper, title insurance is going to be a little cheaper, and so on and so forth. Okay. But this is kind of a firm break understanding. Okay. Now, as I put it down here, remember taxes and insurance will be high, right? Depending on your prepaids and escrows. This example does not include, as I mentioned, your discount points, your survey, your points, and some items. Okay. So based on experience, I would say, pull out my calculator really quickly and I'll show you guys. A lender's fees like ours right now is about 1,800. An appraisal is about 550. Credit report is about 100. The attorney right now, they're usually charging anywhere from 15 to 2,000, 1,500. Title fee, let's say for a $400,000 house, is about 3,500. Your recording fee is about 600. Prepaid interest, let's say, depending on when you close, $600. Now your escrows and prepaids, this is where it is. If you're buying a property that is about $1,000 a month in property taxes, how much do we have to collect? We have to collect 2 months of taxes for escrows and 3 months of taxes for prepaids. So that's about $5,000. Plus, we have 2 months of insurance and 12 months of insurance. Let's say our insurance is about $100 a month. 100 times 14 is $1,400. What did I tell you guys? $15,000 would be the average of what I would generally say would be the estimated total closing cost of your third-party fees plus your prepaids and interest. Now, again, guys, this does not include if a client has to pay points, which many instances right now, most of my clients are paying anywhere from 1 to 2 points, right? And it's not by choice; it's what the federal government and how margins are set up. So, if you're paying if you're purchasing a $5,000 mortgage, and let's say you're buying let's say your loan amount is 300,000, you're about, let's say 3,200. So if you add 3,200, your total closing cost is about 18 grand. Okay. So you have to tack that onto what your potential down payment is as well. Okay. Does anybody have any questions? I know once I start doing numbers, I tend to sometimes start losing people. Anybody have any questions on this stuff? Awesome. So now what I do want to touch base on with us is how do we actually get this stuff given to us, right? How do we know what our total closing cost is going to be? Are we just going to believe Abdel and everything that he's telling us? I hope you guys would. But you guys are federally obligated under the loan estimates with the closing disclosures to receive this. So again, your down payment isn't the only thing that you guys need to bring to the closing table. When you are paying your closing table, you also pay again your closing costs, which are expenses that you pay in exchange for services, as we mentioned, right? So you get a 373 rule, which is the TILA RESPA integrated disclosures. Once your offer is accepted, the lender has up to 3 days to give you the loan estimate. He has the ability to close as fast as 7 days. And before you close, you must get what's called the CD, which is the closing disclosure. You must get that to be eligible to close within 3 business days. Okay. So 3 days for LE, 7 days to close, 3 days to close. Our lender's still rolling in closing costs. So it's not necessarily rolling in closing costs. It really depends. We were talking earlier about sellers' concessions. So sellers' concessions is generally the only way that you have the ability to necessarily roll in closing costs, right? Where, the example I was giving, we had a client buying a $215,000 home, house appraised at 219. What I advised them to do was increase the purchase price to 219. First, make sure everybody agrees to it. Increase the purchase price to 219. Attorneys, you guys are cool. We're compliant. We're abiding by the necessary rules and regulations. And then they ask for a 4K concession. In that instance, the client can roll in the closing costs. Okay. Don't get too, there's a lot of different, trying trying to be cautious with my words, but there's a lot of different strategies as to what other institutions say when a lender is simultaneously going and saying they're covering your closing costs. It's really impossible when you're purchasing that. Okay. So you want to simultaneously make sure you want to keep all the necessary items in place where you could be getting a slightly higher interest rate and those fees that you're receiving. So for example, if you're going to lock at a 6.5%, the lender may give you a 6.75%, and that extra interest rate, whatever is remaining, you actually, instead of paying money, you get money back, and that money back pays for your closing cost. Okay. And then another thing, as a first time multi-home buying, that's a lot of fees. Yeah, I mean, listen, buying a home is not cheap. And it's our obligation to make sure that you're simultaneously educated about the necessary options that are available for you. Again, there are various different tactics that you're able to do to employ them, but there are a few different hands that are involved in a transaction. I would certainly make sure that if you are a first-time home buyer, or even if you're an investor or whatever the case may be, you're having a very transparent upfront conversation with the lender, getting a firm understanding of what your total closing costs are going to be, right? And for some instances, I have a client who was actually wanted to pay more, right? She had about $50,000 saved up, and her closing costs total, I was recommending to go with the cheaper option of, it was like 42. And it just makes more sense to save the upfront costs up front while simultaneously leaving the extra money to close. So certainly no shortage of different tactics that are involved when you're purchasing a home. It is mainly just understanding what are the various understanding. Now, remember, one of my partners who was just on here, right? She had connected us with a she does a lot of rentals. So we're basically going to be looking into all the clients that rented, in today's day and age. I mean, I haven't rented in quite some time, but I generally know it was always like you move in, you pay your first mortgage, your last mortgage, and then the security, if it's still like that. Dude, that's like 10 grand. That's a lot of money. So $10,000, yeah, it's your money, it's a security deposit, but same thing when you're buying a house and you're putting a down payment, that's your security deposit, right? You're no longer buying the house for $300,000. You're now buying the house for, hypothetically, let's say 3.5% of 300, let's just say, is 12 grand. You're now putting in a security of 12 grand to your own house that you're building your own equity into. Okay. So that's kind of how I necessarily look into it. Now, are there various ways of why you can simultaneously cut certain costs? Yes, you can. Oh, my phone just died. Excuse me 1 second. Sorry about that. My phone just died and I had it on Instagram. But so there are different things that you do have the ability to simultaneously cut out, right? So I'll kind of wait to answer that question because that was one of our shows. But can I use equity in one home to buy another? Great question. So so there are different ways, right? So generally what a lot of clients are doing, this was Jess. So Jessica, what a lot of clients are doing right now is different cash out refinances is something that's very, very common right now. And, a lot of people get scared, if that's the right word, to not touch their first mortgage, right? Where it's like, oh, dude, I have an interest rate like 4%. Why would I buy a house at 7%? So I say, okay, well then let's look at the options of doing potentially a HELOC, right? A home equity line of credit. Now, you want to be very careful when you're getting a HELOC, a home equity line of credit, because in many instances, those HELOCs are adjustable rate mortgages, okay? So those HELOCs that you may potentially get, those rates change, they fluctuate, okay? So as they continuously change and fluctuate, so does your payment. So I have a client right now, referred to me actually by a colleague. They're selling one of their properties in Elizabeth, and now they have a property in Newark that they want to necessarily basically pull cash out and most importantly, pay their first HELOC that they just got. In January, they were paying $1,400 for the HELOC. It's a $180,000 HELOC. Now, their monthly payment is almost $2,200 a month, and their balance is going up. Now their balance is almost close to $200,000. So they're going backwards, right? They didn't want to necessarily touch their first mortgage, which actually wasn't even that low. It was about 5.25%. So I ran the numbers based on doing a cash out, paying their first mortgage and the HELOC. They're getting a 7.625% interest rate. It's a 3-family home in Newark. So a few different various factors. Whenever you have more than one unit, basically 2, 3, 4, there's risk factors, which is why the client won't be at 7% or 7.375. Maybe a little higher because it's an investment property. 7.625. Their monthly payment saving between paying the first mortgage at a 5% and the HELOC, they're saving $600 a month. And it's fixed and it's never going to change. Okay. So I think that's the importance of breaking things down when we're doing those cost analysis understanding for our clients as to what makes the best sense for them to look into. This thing charging. Jessica, does that answer your question? Yeah, it's charging. So what if the house is already paid off? Very good question. So same thing. So if the house is already paid off, we would just do a cash out refinance. So for example, house is paid off, you're only paying your property taxes. Based on what you want to take out, a conventional loan, if it's a single family home, you can borrow up to 80% of the loan to value. Not that you have to. So hypothetically, if the house is worth $500,000, you have the ability to borrow up to $400,000. Now you would have to qualify for that, but you don't necessarily have to take out that much. You could say only take out 100,000 or 200,000 and use that towards your next purchase. And just that's exactly what a lot of my clients are doing right now. A majority of my clients who purchased with me in 2017, 2018, 2019, that's exactly what they're doing. They're calling me and they're like, yo, dude, I got to pull out money. We do a refinance in less than 2 weeks. We pull that cash out. And then all depending on many instances, they don't want to leave their current home. So we do it that way, where we pull out the money as an owner occupied refi and they buy an investment property. Okay. So it works synonymous either way, right? You certainly can do a cash out refinance and simultaneously still pay it. You're now going to have a new mortgage payment. You have to qualify with a new mortgage payment and then take it from there. Okay. Now I've actually done some gifts of equity too. That was fun. I actually did one. It was really, really difficult. But the brother was basically the brother was buying, his brother's house. The client's brother was buying his house. And it was tough, let me tell you. It was not an easy transaction. But we did a gift of equity that actually paid for the client's down payment and paid for the client's closing costs, right? So again, kind of becomes the strategies of what's in place that you want to make sure that you're working with the right mortgage lender. Sorry, guys, I'm putting up the live thing right now. But you're working with the right mortgage lender that is going to simultaneously set those proper expectations for you. Does that answer your questions, Jess? Awesome. Perfect. All right. So kind of moving into that. So now what are closing costs? So this is going to be a little bit of a kind of a recap of what we went over, and then I'm going to show you guys how it's necessarily read. And please, as you guys have your questions, put them in the chat box or feel free to unmute yourselves. But again, what are the closing costs? So closing costs are itemized on the LE and CD. So closing costs cover things like your home appraisal. They cover things such as searches on your home title, your attorney, your bank's origination standards, and other third-party costs as we've been discussing. Okay. For those of you guys joining us right now on Instagram, sorry about that, my feed got cut, but we're going over the third session for the Advancing Homeownership Workshop, specifically in reference to closing costs. We've got this going on 3 different platforms, so I'll try my best to get to all of our questions at the same times, okay? But as we are explaining, the closing costs that we went into, as I mentioned to you guys, right, I always like to break it down into what? Into 2 different sections, right? We have the third-party closing costs, and then we simultaneously have our prepaids and escrows, right? That's the part that I was explaining to you guys when we were doing the number calculations together, okay? So as I always say, it's nearly impossible to truly put a percentage behind how much closing costs are. It's so difficult because you could be simultaneously purchasing a home that, as I mentioned to you guys, is $200,000. And if you're talking about 2 to 3%, it's $4,000. That's basically what the title company and potentially the attorney is going to be charging. Okay. So very difficult for us to put that percentage. As I had mentioned to you guys, the average expectancy, if you're buying a $300,000 home, the closing costs is going to be anywhere from 6 to 9,000 plus your prepaids and escrows, like we went over. So if we're saying $6,000 to $9,000 in your closing costs, and then we double that up with our prepaids and escrows, we're at that $12,000 to $18,000 of what we were looking at together. Okay. So now kind of going into it again, the main things we're going to be looking at is taxes and insurance. Taxes and insurance are going to be 2 of the driving forces that is going to advise us if our taxes are going to be, or if our closing costs are going to be a little bit lower or a little bit higher. Okay. Now, also, guys, this is a sample loan estimate. Okay. A loan estimate is what you receive. Again, you guys remember I explained the 373 rule. Okay. You're going to receive this loan estimate, and you're also going to receive something called a closing disclosure. They are basically synonymous within the 2. Okay. They essentially represent the exact same thing, and they also set the proper expectations for you as to what the total costs are. I'm going to actually put the Zoom link again in the chat so it doesn't get lost. I did before. That. Okay, cool. All righty. So now let's take a look at this example that we're looking at it right now, right via the screen. So we're taking a look at the loan estimate, the date issued, again, who the applicants are, if you guys can follow me, the property address that they're purchasing. This is the sale price. Now we take a look at the loan terms. It is a 30-year mortgage, right? It is a fixed rate mortgage. They are simultaneously doing what? They're doing a conventional mortgage. You're going to get your loan ID number, and then you're going to be advising if the interest rate that the consumer has is currently locked or not locked. Okay. The loan amount is $162,000. Now, how did they get there? If you take 180 and subtract that by the down payment, which you guys see over here of $18,000, right? 18,000. That brings us to 162. The interest rate, which would be great right now, 3.875. The client's principal and interest payments in this case is $7,768. In this case, there's a prepayment penalties. 9 out of 10 times, guys, probably 9.9 out of 10 times it. The type of mortgages that you would normally get that I would potentially offer has no prepayment penalties. No prepayment penalties within the mortgages that we have in place, right? So now when we're looking at our total monthly payments, in this case with this client, it's going to be $1,050. We have our principal and interest payment, which is $761. They're only putting 10% down, right? So 180,000, 10% down is 18,000. That's why they have mortgage insurance, $82. Plus their escrow of $206. That brings us to the $1,050. Okay. The client's estimated closing cost is about $8,000. Now remember, this is a $180,000 home, and the closing cost is $8,000. Okay, so super important for us to keep that in mind, right? So many of us are usually buying homes, especially when we're buying in Jersey. For those of us who are on here from New Jersey, the closing costs are, I mean, we're buying $400,000 homes, which is essentially almost double and change, right, to what we're buying. But in this case, you're seeing the average closing cost is about 18,000. Client's total cash to close is about $16,000, which subtracts any deposits that have been given. Okay. Now, how does this get read? So Section A is usually your standard bank origination, right? And again, guys, this is pretty old. This is from 2019. This is actually straight from the CFPB website, the Consumer Financial Protection Bureau, which again, if you guys have access to the datable that I shared in here, you guys will be able to put all the information in here and go back to it, right, with the specific link. But you'll see here, Section A looks like it's about $1,800 in their total fees, which includes the client's points, application, and underwriting fees. Then we simultaneously have over here, we're going to be taking a look at what are the services that the consumer, quote unquote, cannot shop for, right? And you're always going to see in Section B, in this section, you're going to generally have two of the most common ones. You're going to have your appraisal fee, which is something that you pay for in advance, and then you're going to have your credit report fee. Depending on the institution, some institutions will charge you up front for the credit report. Many institutions like ours, we just wait till the end of the transaction, right, to have it charged, okay? Flood determination, tax monitoring, tax statuses. I generally haven't seen those when I disclose our files, right, for our staff. But it could be any type of transaction depending on when the home is simultaneously being closed, okay? Now, services that you can shop for, which is generally in this section, Section C, is usually where you guys are going to have your title and you're going to have potentially your survey. So depending on if you have a title or a survey, it would generally be right over here, okay? Now, you guys see that. So under Section D, the average closing cost in this particular example is roughly about $6,000. Now, looking here, under Section E, we have our taxes, what the client is paying for the taxes. Looks like recording fees in this case is only $85. Clients prepaids in this case, they're collecting 6 months of home insurance and then roughly nothing for property taxes. So it just depends on when they close within the tax roll. And then here you have your escrow. Always escrows are going to collect 2 and 2. I mean, the reality of property taxes only being $105 a month in the state of New Jersey is probably never. It's usually about $1,000, right? Which is basically probably the difference why it's so cheap at the $8,000, right? Okay, now if we take a look at how everything broke down, the total closing costs again for this client was about $8,000. They gave a down payment, or they gave a deposit of $10,000. We have a down payment of $18,000, which gets added. So if we take 8 plus 18, that gives us roughly about 26 grand in change. Minus $10,000 deposit is where the estimated cash to close is 16, which is what the estimated cash to close is on the bottom here, 16,000. That makes sense? So again, as I was saying earlier, and you see it here, there's no such thing as surprises, right, anymore when it comes to cash to close needed at closing. When are you supposed to get the idea of the cash to close? When we have a complete application. And when I teach this to our students with the mortgage school that I have, it's called aliens. We have the address, the loan amount, the income, the estimate value, the name, and the social. When we have those 5 things, again, the address, the loan amount, the value, name, and your social, that is generally when you're supposed to be receiving your loan estimate, okay? When the offer is accepted, you have the address and you have the value. You should simultaneously have the ability to be able to receive an idea of what your total potential closing cost is going to be, okay? Now, again, TRID, which is the TILA RESPA integrated disclosures, replaced all of these different disclosures, which is TIL, Truth in Lending, Good Faith Act, HUD-1, which is the Housing of Urban Development, and then the TILA integrated lending disclosure. So you must receive, as I mentioned before, the loan estimate within 3 business days to give the clients the idea of what their cash to close. And there's also something called a cumulative tolerance, meaning the tolerance for fees of what's disclosed may not exceed more than 10% of what the client is potentially going to be paying, okay? So you have that. Now, when we take a look at the other side, The first page of an LE, I already broke it down for you guys, literally down to the wire, but you'll take a look at it, right? So again, the first table here that we have, your loan amount, your rate, your principal and interest, and then if there's a prepayment. Then the next table we have here is going to show the breakdown simultaneously of what your closing costs, what's your total cash to close. We're going to have over here, what is the potential breakdown in terms of the monthly payments and how it got there. And then we also saw here when we're explaining it, section A, as you guys see here, right? This is the bank origination charges, which can include either any of the points that you elect to pay your lower interest rate, along with standard bank originations. Then we have our section B, which, as I said, is the section in which fees you pay sometimes in advance, such as your appraisal, your credit report, and other different various fees that may or may not be included in the transaction, right? Not every single home requires flood insurance. Therefore, you don't necessarily have to pay for a flood insurance determination if it's not in there. And then our section C, we'll see here, as I mentioned to you guys, it's a title, usually in a survey. That is usually where you'll see the fees for those costs being broken down to. Now, when we're looking at the bottom, as I explained, section E at the top right, we're going to have is our taxes. We're going to have our prepaids and escrows. So the section of prepaids is usually 12 months of insurance, and your prepaids is usually 3 months. And then when we have our escrow, it's usually 2 months of insurance and 2 months of taxes. That is what brings down and gives you your escrow. Every single year, you as a consumer, when you close on your home, are going to receive an annual escrow notice. It's going to tell you how much money is being held in the piggy bank, right, by the institution. And it's going to show you everything that is broken down for you and what, if you sell your home or you refinance, that money is given back to you, right? And then again, section H is usually where I always break down and tell you that that's a title insurance. Always says optional. It's generally we necessarily won't close without it, right? Recapping sellers concessions that we went over earlier, right? So you could place an offer on a home with seller's concession and have a seller cover the closing costs. Again, understanding that when you are putting an offer on a home and you're requesting seller's concessions, unfortunately, 9 out of 10 times, your offer is going to be not as favorable to a seller compared to somebody who may be offering with. Again, not to turn us away from thinking it's impossible. I do have deals nowadays that are still getting accepted with seller's concessions, okay? Just understanding and working with your real estate professional and your lender so you guys can strategize, which is actually going to be the topic for the following home buying seminar in 2 weeks, where we talk about strategizing and game planning, when we're placing our offers, right? And then we went over certain caps for the different loan amounts, right? A conventional loan, the max is 3% if you put less than 10% down. A VA loan, the max is 4%. There's no down payment restriction. FHA, the max is 6% down. Again, no down payment restriction. And then conventional, the max is 6% down if you put more than 10%. Okay. So again, guys, remember you have access to these slides via the data vault. So make sure you guys look back into it. And just like we broke down, right, our total closing costs, how did it break down to the cash to close? In this instance of the example that I showed you guys, the total closing cost for that client was $8,054. Their down payment is 18 grand. So if we add 18,000 plus 8,054, that gives us what? 26,054, which is essentially the total cost to close the transaction. These clients gave a deposit of $10,000 up front, yielding their remaining estimated cash to close at $16,054. Okay. And again, the reality of total cash to closing costs only being $8,000 is very, very slim to none. But at least this gives you guys a firm understanding of, we take our total closing costs plus the potential down payment. Usually sometimes here you guys will see we'll have adjustments and other credits that are usually put in there. In there, you'll usually sometimes have the seller's water, sewer, taxes, solar panels, or things like that may necessarily have to be adjusted if the seller paid for them in advance, or if the seller did not pay for them in advance, then you'll see a negative there at the same time, right? So you're not paying for it as well. Okay. Does anybody have any questions? Check the Facebook. We're good. Check my IG. I closed it off before. Perfect. All right, guys. So I'm going to kind of break down one more thing for us. And then please, if you guys have any questions, let me know and I will break it down for us even further. But we're going to be taking a look at, again, kind of a quick understanding of, now that we've gone over closing costs, another thing I want to make sure that we understand, and I spoke about this briefly in the beginning of our call, is what is included in my mortgage payment, right? So we've figured out, we're experts now together, now that we've gone through this journey with the classes of the FHA versus conventional loans and the differences. We've gone over the 4 C's and the qualifications of that standpoint. We've gone over various different intros to the home buying process with the steps and what we're supposed to do. We have an understanding of the closing costs, but 9 out of 10 times, one of the questions that I always get consistently is, what is included in my mortgage, right? And I'm going to go over that with you guys again in specific detail and leave us open for rooms for questions, and then we'll chime us out. So what is included in my mortgage payment, guys? So when we're looking at our mortgage payment, again, it's broken down into something called your PITI, P-I-T-I, which is your principal, you guys see here, your interest, your taxes, and your insurance. Now, all depending on the specific property, specific property type that you're purchasing at the same time, you could also potentially have an HOA fee, which is a homeowners association fee, which is what you pay for towards them mowing your lawn, shoveling your snow, and so on and so forth. Okay, so that gets tacked onto your PITI at the same time. Okay, now the different types of insurance that you have will also simultaneously go everything down there: your principal, your interest, taxes, your insurance, and your HOA. Will the buyer get a breakdown like this for the house file once closed on the home? Are you talking about the stuff that the seller signs, or are you talking about the loan estimate and the closing disclosure for the breakdown? So we'll wait on that. But again, when you guys are going through a transaction, just so I can explain it again, it's the 373 rule. Every buyer gets a copy of the loan estimate 3 days within closing. Any changes that are done to a transaction throughout simultaneously goes. Yes, the closing structure. So within 3 days before your scheduled business day closing, right, you get your closing disclosure, which is basically the exact same thing as the loan estimate. That is about 90 to 95% accurate of the final numbers. Okay. And the reason why it's not 100% is because we're still waiting on the title company to get the full blown, like literally down to the day accuracy of the sewer, water, title, and stuff like that. Right. And it unfortunately is sometimes like the day before or the day of, like down to the penny. This is what you need to bring via certified check or via wire. Right. But a client does 100% get a breakdown of all the costs through the transaction. Any changes that occur through a transaction, it's called a COC, a change of circumstance. Clients get a copy to re-sign it. And then 3 business days before you close, you must sign the preliminary CD, which gives you about a 90% accuracy of the final numbers. And then once everything is finalized and matched, right? Generally, the lender that you're working with, he is going to give you a copy of that. What I always do for my clients is I actually simultaneously always record my screen. So I'll actually show you guys an example. When I'm going over final CD explanations, I will also always shoot a bomb video that, let me see this one. Yeah, here you go. So this is one where I actually personally, for every single client, like to record my screen and actually literally shoot a video recording my screen and breaking down everything, basically how we just went through it right now, right? So everything is explained, and then we obviously know if, for example, this client just closed last week, 725, is that last week? Yeah, last week. So we know she watched it 100% based on the video that I sent it. So, all right. But you do 100%. If all lenders give you a copy of it after, I have no idea. But I can confidently tell you that we do. So what's the principal and interest payment for? Okay. So principal is the money that you originally take, right? If I give you $100 and I tell you, in 2 weeks, give me $120. The $100 is the principal and the $20 is the interest, basically, plain and simple, right? So principal is the money that you originally agreed to pay back. Interest is the cost of you borrowing the principal. Okay. The funniest thing I always see with people is like, it's all these, I don't know if I'm gonna say conspiracy theorists, but they're like, you buy a house and it's $300,000, and by the time you're done paying it, it's like $500,000. Well, yeah, dude, you buy a house for $300,000. One, you're putting the least amount of money down. Two, by the time you're done paying it, it's probably worth $1 million. I'm going to say $1 million, but it's probably worth that much more, right? A lot of the people who bought their houses in 2000s right now are sitting on $300,000 of equity. It all depends on how you're looking at it and your motivation, but building generational wealth nowhere near attributes anywhere near real estate, right? And building equity at the same time. So going back to property taxes, so your property taxes are paid by the homeowner to fund what? At least we think this is where our taxes go to fund our water, to fund our sewer, to provide law enforcement, fire protection, education, road and highway construction, libraries, and other services that benefit the community. Again, big quotation mark on where our taxes go to, but that's essentially where our property taxes in the Webster's dictionary go to, right? Funding our water, our sewer, paying our law enforcement, our teachers, road, highway constructions, and stuff like that, right? Now, what's the hazard and mortgage insurance for? So remember, there's 3 different types of insurance. So I'm going to talk about the 2. So hazard insurance is your Geico, Progressive, Liberty Mutual, Travelers, right? That's required for a home, which protects the home in case there's a fire or an emergency or anything of that nature, which I'll be honest with you guys, home insurance right now is truly starting to be a little bit of a tricky, sticky factor, because what we're starting to see is when we're seeing home insurance, a lot of different big carriers in some states are leaving. Florida, California, they've gone, right? Some of my insurance colleagues that I work with as our business partners, and they tell me, Jersey's really not that far away from being one of those states that some insurance carriers are just denying the requests for claims, or not claims, denying requests for new coverage. So keeping that in mind, right? So hazard insurance, I used to quote clients before, I would say at like $75, $100. Now I quote my clients when we're building a transactions for debt to income purposes at 120, 150, because I know that the policies are generally a little bit more expensive than they usually are, right? So that's that when it comes about hazard insurance. Now, mortgage insurance. So again, guys, mortgage insurance depends on your loan to value and depends on your loan type. So right now, mortgage insurance for an FHA loan, in some instances, is actually sometimes more affordable than mortgage insurance on a conventional loan, because the Joe Biden administration came out and they dropped the mortgage insurance requirement to 0.55%, which is now making it a little bit cheaper sometimes to get an FHA loan over a conventional. Okay. So mortgage insurance, when we're talking about it on an FHA loan, if you put less than 10% down, it's forever. If you put more than 10% down, it falls away at 11 years, which many instances people will get rid of it before then. On a conventional loan, if you put less than 20% down, you have mortgage insurance until you reach 20% down. Or you can prepay your mortgage insurance upfront, which I have had some clients do, right? Hey, dude, again, if they're monthly payment conscious, save the upfront cash to close. Don't put 20% down. Let's put 15. And then let's prepay your mortgage insurance, which is going to take that away. So you don't have to worry about that. And then the value of the property is appreciating. So many different factors, again, that are in place. But usually a lot of that stuff, when I'm working on it with our clients, I would have probably set those plans in place before. And then also another type of insurance that's actually starting to becoming very common is flood insurance. So, after, I don't remember what it was. I think it was Hurricane Ida, the one that was like 2 or 3 years ago. That truly changed a lot of the maps in the state of New Jersey. Like that shifted a lot of the different maps that are in the state of New Jersey. Where some areas like South Plainfield, Elizabeth, and things along that area really started redrawing their maps, and now they have flood insurance. And guys, flood insurance in some areas is not cheap. It could be as high as like $3,000, $4,000 for flood insurance annually. So pretty expensive. Again, that gets tacked onto your payment. So I always like to make sure with my partners that when we're looking at a home, they let me know if the property is in a flood zone. Because if the property is simultaneously in a flood zone, obviously I need to factor that in, because that's going to affect the client's monthly payment, which is going to affect the client's debt to income, right? Now, what is the homeowners association for? So homeowners association is specifically in an effort for them, like I mentioned to you guys, right? That is the fee that is paid to the HOA to oversee the common area, right? Oversee the property area, run different business affairs, enforce them, set proper rules, and see the maintenance and upkeep of the area. Okay. So that takes care of that when we talk about mortgage payments. Does anybody have any questions? Anything in regards to closing costs, expectations, anything that you would like us to kind of touch base on a little bit further for our next classes, before I kind of lead us out for the day? We're good. Okay, cool. So again, guys, 2 weeks, again, every Thursday. I totally recommend, if you guys have the ability to jump on for the following class. This is probably one of my favorite topics that I talk about, and really a lot of the different topics that allow us the ability to get our clients' offers accepted, keeping listing agents in communications, making sure we're strategizing with our buyers, giving an understanding of client engagements, right? Forgetting about the interest rate. This is something that I always tell my clients when we're going over, especially right now, right? Strategizing for our offers, a top tactic. So really recommend, if you guys have the ability to jump on for the following meeting, you guys do, because we're going to go over a lot of very good strategies and topics that is truly allowing our clients, in this market, we're still blessed to have the ability to still stay, within the region, and still stay simultaneously really successful, and take it from there, right? So question, does the closing cover 1 or 2 months of mortgage payments? So really depends on when you close. So the prior session that we went over, so for example, if you're closing at, let's say, anytime after the 7th. So if you're closing, let's say, within this week, 14th to the 1st, your next monthly payment is not until October 1st. Okay. So you kind of sort of get, I don't like to say it's free, because a consumer does prepay interest. You don't have to prepay the principal, right? But you do prepay interest. So in this case, if you're closing within this week or even this week, you do simultaneously more or less get about a month and a half for free, however you want to look at it, or included within your closing. So it is kind of also simultaneously, like I said, judging based off of when you close. Where did I put that question? I think it was this one. Common mortgage questions. Yeah, so when is my first payment due? So again, like literally put, actually, one of the most complicated answers. So if you're closing August 14, will that cover September? Yes. So if you're closing August 14th, your next first mortgage monthly payment won't be until October 1st. Jesus, I think I said July. Sorry about that. Yeah. Our next monthly payment won't be until you skip the middle, you skip obviously mid-August, you skip September, your next monthly payment is not till October 1st. And you kind of see it here. So as I said, it's one of the more complicated questions, but it depends on when you close on your home and if you pay prepaid interest at closing. It can actually be complex. So if you close late in the month, chances are your first payment will be due in just over 30 days. If you close early in the month, which, whatever constitutes early, before the 15th, you basically kind of get a little over 60 days, right? So you get until October 1st would be your next mortgage payment. And it's usually broken down at the closing table. They generally give you the information and they'll tell you this is when your next mortgage payment is due. And then you take it from there. Your lender will set up the institution as to you pay automatically or you send a check or whatever the case may be. Okay. So that's that. Now, again, guys, I put in the chat here the it's right here, the data vault. So make sure you guys have the ability to go in there and go. Now, an added bonus for some of you guys who stayed in here. My company and I were blessed to actually have an awesome application, and I'm going to share it with you guys right now. So you guys are going to be able to sign up for this today, and it is 100% free. So this is the institution that I work with, right? My branch was selected. We did get the #1 branch within the entire region. So we actually were able to get the opportunity to pilot this program via Fannie Mae and FinLocker. But this is super, super cool. I wish I had these tools earlier, but this actually gives you the ability, and some of you guys who follow me on social media, I shared this. You're now going to have the ability based on that link. So if you guys want to sign up for this, again, is 100% free. This is going to give you guys the ability to simultaneously track your home ownership goals. So if you're somebody out there who's just getting started or tracking your finances or stuff like that, it is 10 times better than Credit Karma, in my opinion, because it's got a lot of different account readiness. It knows your individual scenarios. It gives you a lot of different mortgage education tactics and key financial features that you should know. You have the ability to go down here, Lender Connect. It'll share various different informations that you guys want to learn from. It'll give you, if you're sharing anything, it'll give you guys different various calculators simultaneously. So if you're a consumer out there who is looking to find out if you're not mortgage ready, this is an awesome app that is custom tailored specifically for you. It is going to give you guys the ability to be able to track early availability. A lot of clients I run into are looking if they pay off their mortgage early, what would be their estimated cash flow. HELOCs was something I was talking to you guys right now earlier with that situation with my client who they got a HELOC from a separate institution in January, $1,400. It was a variable interest rate. They're now paying $2,100. So super important for consumers to have that understanding of what is the difference between the two, right? That variable rate. The Federal Reserve increasing their benchmark interest rate directly impacts short-term rates. So it directly impacts your HELOCs. It directly impacts, when's the last time you looked at your credit card statements? They're almost at like 30%. I remember like mine never used to be like more than 9.9. I was looking at my American Express the other day and it was 29.9. Freaking crazy. So taking a look at that stuff, it gives you also some various different calculators. Now, the cool part too is this allows you guys, as I've shared previously, the ability to link your individual credit. It does not affect your credit score whatsoever. You guys have the ability to link it directly. and it will actually give you some credit simulations based on the accounts that you put in, where if you guys want to simultaneously pay account A, B, C, you have the ability to do it. You also have the options to link your bank accounts. Again, it is 100% proprietary and confidential, stays within your own fund, but it actually tracks your spending too. There's another app I've personally used before I got this one, called Rocket Money. It does basically the exact same thing. It actually tells you what's the consistent accounts that are coming out. Now, if you also own a property, it'll actually tell you what your property is worth based on this idea, and it'll give you an understanding of where your home value is. And it's pretty cool. It actually shows you some of the common comps that have sold recently within the area compared to your home value from when you last purchased it to when you're buying it now. So really, really, really cool application. I highly, highly recommend. Again, you guys are going to get access to it for free. It's in the chat that you guys have the ability to. Feel free to share it with your individual colleagues or friends or clients or anything of that nature. Even if you bought a home, not necessarily a bad thing for you to be able to stay on top of that stuff, right? This is also pretty cool. It lets you, let's say you have the necessary cash to close. It'll tell you if you just started a new job, what's the employment history that you need to attain, whether it's a 2-year history. Again, the goal is obviously 730 days, which not the same job, right? You just need to have a 2-year working history. You can have 4 different jobs, but you just need to have a 2-year working history. And even if there's a gap, depending on your specific circumstance of what your history was before and how long you've been back at your current job, along with the loan type, there are different avenues that COVID allowed us to kind of pivot within the requirements. Okay. Credit score requirements, right? So if your credit is a little light and that goal, as I always say, 640, I have done as low as 566. We're about to close on a cash out refi for a client of mine, FHA cash out refi, 566. Granted, his loan to value is there. He's only borrowing up to 65%, but it's a 566 credit score. And we still have the ability to get the deal done. Okay. But of course you want to get there. And then looking here, the debt is a little high. That sweet spot is that 25 to 30% of your monthly revolving credit card debt and installment debt or DTIs and stuff like that. So that's where you kind of want to be at, right? That 43% max debt to income ratios would be where you guys have it. Okay. So you guys have access to this link. I'll leave us based on that. Does anybody have any questions as to a lot of the topics? We did cover a lot of the topics today. I hope we were all able to take some important information and notes. Again, remember, if you guys go back to this data vault that I have shared with you guys, it's going to open up here. There's so much information in here that you guys have accessibility to. Home buying 101 with various different steps, a lot of different information. Let me do it this way. How do I change the view? Here you go. The next topic, again, of the agenda that we are going to be covering, guys, is ways to get our offers accepted. Super, super excited for that. I love sharing the various strategies and tactics that we're doing in this market, allowing us to be the #1 branch in the entire region with 2,700 branches that we're currently working with. So a lot of different things that we're putting in here, guys, that I want us to truly have accessibility to. So does anybody have any questions before I kind of let us go? We're good. All right, cool. Well, I appreciate you guys jumping on. Thank you as always. Any questions that you guys have, you guys all have my contact information. Feel free to shoot me a message, email, text, and I certainly look forward to catching you guys again in 2 weeks, and we'll take it from there. Thanks, guys.